Welcome to the UTI Swatantra series powered by ET Now. I'm Faye D'Souza. It's such a pleasure to have you tuned in this week. We're talking about taking risk and what sort of risk is associated with a mutual fund investment. How should you as an investor decide whether or not you want a mutual fund investment in your portfolio? And to help us answer all of the questions that our audience have brought into the studio, in the studio with me today is Joseph Menezes. He's the Director of Fortune Life Wealth Management Solutions. And Vishal Pandey, Director of VP Wealth Management. Gentlemen, thank you so much for coming in. People tend to shy away from mutual fund investments because they believe that it's inherently risky. We all have fixed deposits. There's no point arguing about that. I'll start with you, Joseph, in the sense that could you explain to our viewers in the studio and those watching at home, what kind of risk am I taking on if I buy an equity mutual fund?
First and foremost, Indian investors are pretty confused. So what is required is a right education. What exactly the mutual funds, what all schemes they have got, what all the options they have got like that. No? So the broader knowledge is absent among the Indian investors.
So, okay, let's start then at ABC.
Yeah.
What is then a mutual fund?
Mutual fund is a one window solution for all the investors, and there is everything for anybody and everybody, starting from savings account holders to fixed deposit holders, pensioners, the working people. For everybody there is a investment opportunity. So you can address practically all the investment solution. I'm not speaking of the risk management from the point of income protection. All the investment and wealth creation needs can be addressed through mutual funds.
Vishal, tell us what the different types of mutual funds are.
See, basically mutual funds, if you talk about, it is divided into two broad categories, equity and debt. But if you again compromise between equity and debt, it caters to all other investment parallelly which runs. Like into a debt mutual fund, you will find there are products which run parallelly with your bank fixed deposit, your savings account and all those. So when you say mutual fund, it is divided into equity and debt. But again, when you decided how to invest and where to invest, you can accordingly classify it.
All right. So tell me what goes into an equity mutual fund.
Equity mutual fund is something that you give a professional, a person, a money on a trust that you invest on my behalf, and he in turn invest into various number of stocks. Basically, equity mutual fund, it is very simple that you may understand what is equity mutual fund. But when it goes practically, a lot of research and all those things get into which an individual doesn't have an access. So you give this management to a company which is called mutual fund company.
I want to take some questions from the audience on investing in mutual funds, and that could be about anything, whether it is, investing from a risk point of view or from a goal point of view. Is there anybody who has a question? Yes.
What's the minimum amount we can invest in a mutual fund? For a beginner, you could say.
You can invest, if you are investing one time, as low as 5,000, and if you are investing on the monthly, on the regular basis, what you call in the normal conventional language like a RD, here it is like SIP, Systematic Investment Plan, it can be as low as 500 rupees.
All right, is there anybody else who has a question? Yes.
Sir, I have heard about gold ETFs. So I would like to understand what is the difference between ETF and mutual fund. Is there any?
Actually, this is interesting, Vishal, because when you spoke a little while ago, you said there are two types. There's debt and there's equity.
See, yes. Within the mutual fund, when it comes to equity and debt, there are a lot of categorization. It starts from index fund, it comes to ETF, there could be a diversified equity, thematic, sector, there can be a lot of fund. Now here the main core topic that we are discussing will really play a crucial role. Your investment into any of this categorization will depend upon your risk appetite and your financial goals. So ETF is something, it is exchange based. Exchange is something which is there in the index. So there are a lot of index, and within the index there are a lot of categorization. So gold ETF is one among it. It depends upon your investment and your kind of profiling and your description given by the advisor. You can invest into gold ETF.
So we basically combine all our money. The fund manager buys the gold on our behalf, and you own a certificate in demat form that says that you own this much gold. That's how mutual fund functions. But there are two types.
Yes.
There's the gold ETF and there's a gold fund of funds.
Yes.
So tell us what the difference is between the two.
First of all, there are three things. One is physical gold. One is gold ETF, what he explained. There is a gold fund. Gold fund is, for example, you are buying, instead of physical gold, you are buying the units of the mutual funds, where in return, the mutual funds, either they will buy gold ETF or a physical gold. So basically, through mutual fund route, it is easy to buy gold fund. So secondly, when you buy physical gold, you have got a botheration. With a small amount you cannot buy, and there is a storage, and it is for a specific purpose. If you are going into an investment, either you should buy gold ETF or gold fund.
Is there any other question? Yes, go ahead.
I would want to know what should one take up as a dividend option or a growth option when you buy mutual fund from the tax perspective.
How young you are?
45.
All right.
Okay.
Vishal, you want to take that?
Yes.
For a young man like him,
Yes.
for taxes,
See, taxation really makes an impact, but when you look at the appreciation and the surplus that you get in return, it will not make a major difference. So it is not tax that has to be looked in when you take an option of dividend or growth. It has to be your requirement of money coming back to you. So when it is recommended for an aged person to go for a dividend option, and for a normal person like at your age and something to go for a growth option. Again, it will differ from an equity to debt. It is advisable most of the time to take a dividend option, because in hand of the investor the dividends are tax free, so there is no botheration to file the income tax and then to pay tax on it.
What is the tax treatment on an equity fund if I opt for the dividend payout?
Equity dividends are tax free.
What is the differential between equity and debt fund then?
There is a difference of the risk, which is the core topic that we are discussing, that how risk appetite investor you are and how do you take risk will depend upon a lot of things like your age, the time of investment, the objective. There are a lot of things to be discussed to decide that what should be your risk appetite while deciding whether you want to go for an equity mutual fund or a debt mutual fund. If you ask as a person from the fraternity, when you start off your investment into a mutual fund, you should start with a debt and then gradually move to the equity.
Let's actually come back to the topic that we have at hand, which is the topic of risk. There are several questions when I'm going to choose an investment. I have to decide what my time horizon is. I have to decide what asset class I want to invest in, what goal I have at the end in mind, whether that goal is 20 years away or it's 5 years away. Where does risk come in that decision?
Before beginning an investment relationship, what we need to understand is, why are you investing? Point number one. What is your investment goal? Maybe child's education, retirement, acquiring a new house, or a dream car, etc. What is the distance? What is the time period we have got? Time horizon. The longer the time horizon, we can pick up the little riskier, high return giving instruments. Shorter the time duration, we cannot take the riskier instruments. So those factors are very important. The relationship between an advisor and the investor would be just like a doctor and a patient. At the initial stage, we need to understand what exactly you are looking for, what is your risk appetite, what is your category, age category. If you are into the age group of younger generation like 20 to 35 and your investment goals is a long time horizon, we can take a bigger risk. As the age catches up, the risk taking capacity goes down because your investment goal is nearing like that. So you can take only lower risk in that situation.
You know, Vishal, one of the investments in mutual funds that I really like, especially for investors who are a little risk averse, you don't want to take a lot of risk, is a balanced fund. So we talked about debt funds and we talked about equity funds, but there's something in between which sort of is halfway between the two. Explain to us how a balanced fund
Mutual funds
works.
in India has given a lot of convenience to the investors. Balanced fund is something which is compromising of debt and equity investment. Most of the portion is invested into equity and rest is invested into debt to minimize the risk. We are discussing about risk. It is important to understand what risk is all about. Risk is something, the loss that you are ready to bear is the one point definition of risk. Now it is important then when you are ready to take an additional risk, that is the loss that you can bear, it is important to understand the time frame of the investment. So when I say ki your investment for a period of 1 year to 3 years may consist this risk, the return expectation will be so much. There is a say, taking no risk is the biggest risk that you can take. So it is important to take risk at some point to escalate your returns and all.
In balanced fund, there are two types of balanced fund. One is debt dominating, that means more debt component is there, it gets a debt treatment from the point of taxation. Then they are called equity oriented, that means minimum 65% of the investment will go into the equity fund. They can go up to 65 to 75% into the equity. So there are two categories of the, broadly speaking, balanced fund.
All right, we're going to take a quick break, but to remember, before you choose your investment, you have to keep in mind your time horizon, your risk appetite, how much loss are you willing to bear, and of course your goal, which is so important. We're going to come back and take more questions from our audience. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. We're talking about the risk that comes with making an investment and what you can do to make sure your money is safe. I want to go back to what Prashal was saying, which is basically taking no risk is actually very risky, which is that if I were to, there'll be a lot of investors who turn around and say, so I'll just leave my money in a fixed deposit. It's safe. I know where it is. I'm not paying any fund management fee on it. I know that there's a return coming in. What is the risk with doing that?
For the past 3 years, all those people who are invested in the debt instrument, like predominantly bank instrument like fixed deposit, they have not earned a single pie after providing for the taxation and the inflation. So what is important is majority of the people, they are innocent or ignorant. They do not understand. For example, if you are earning at 9% from the bank fixed deposit, you understand that you are earning 9%, but you need to provide minus the taxation and the inflation. If you know, last year inflation was as high as 9% and above that. So in reality, that is a bigger risk. At a time, debt instrument or what you believe to be safest investment is not creating any wealth for you. You are taking a bigger risk, but the only thing is that out of ignorance.
Actually, let's talk about risk from an asset allocation point of view. Is it fair to say that whenever the stock market will do well, it tends, the returns on fixed income tends to be a little softer, and it works inversely. So if the stock market is doing badly, normally, the debt mutual funds work better. So if I do half and half of two, will I be okay?
Such kind of formulas exactly won't work because basically when you are investing, first of all, you must know why you are investing. You need to have your financial goals. You must know what is your purpose of investment, what exactly you are looking for it, and based on that, you have to buy both equities and the debt, and both the instruments are wonderful. The thing is that you must have a clear conviction for what purpose you are buying.
What if I'm an investor who feels like I want my capital to be safe? I'm not so worried about the return, I just want the principal to be safe. What sort of an investment would you recommend for me?
Within the debt mutual fund, there are a lot of categories available. It starts from liquid fund to a short-term bond fund, to a bond fund, to a gilt fund, and there are various other categories. I think liquid fund actually matches your savings rate kind of returns. So if a person wants to park the money into saving bank, he can park it into a liquid fund. You will get returns better than a savings fund, and you, as the name suggests, get the liquidity. So here your money is safe. Again, if your time horizon is about 6 months to 1 year, you can come into a short-term bond fund where these people invest into a paper or a security or a bond which is in the time frame of 6 months to 1 year. So there you can invest, your money is completely safe, and you may get a return better than the fixed deposit for 1 year that you avail in the bank.
We have questions from our audience members. There's a gentleman in the back. Go ahead.
Just wanted to know that is it advisable to invest lump sum or should go for a SIP?
There is an option called one time you can invest an entire investable surplus into a liquid fund, and from there systematic transfer plan from liquid fund to equity fund or a balanced fund based on your risk appetite. The money can be transferred, and that is a much better option. But at the same time, one should not have this kind of fear also that market will come down by 50%. Yes, nobody can rule out what would happen tomorrow in the market, but that is a better option for a person who is not willing to take risk. I can ask you on the other side also. Let us say tomorrow there is a 20% appreciation in the market, then also you will have the regrets. One thing keep in mind, your decisions will not be always perfect, and you don't have to time the market. You have to invest your money with a good time horizon and with a good investment goal. That's all exactly.
If you look at it over the last, say, 15 years, there's very little chance of losing money in the market.
Time horizon makes a difference. So if you are having a time horizon more than 5 years or 6 years, you can always come to equity. It doesn't make a difference whether to come through a mutual fund lump sum or through mutual fund SIP.
The lady in the front had a question. Go ahead.
I have a question with regards to risk. As an investor, I'm an aggressive investor, right? But over-aggressive tends to be slightly more reckless. So how do you get prudence into your portfolio?
So what do you mean by aggressive investor?
Overextending, right? So you take very, very aggressive bets, but they're good, they pay off. When they pay off really well. But at the same time, it does not, or the volatility of the portfolio is not managed well. So how do you do that?
This is where a fund manager comes in, isn't it?
True. See, basically into our country, we categorize risk very broadly. When you define yourself as an aggressive risk-taker investor, you certainly have to check back in the history to see that what was your reaction when you felt losses. And that is where the asset allocation comes into the picture. When your asset is divided across asset class, one loss into an asset class will compromise with the profit into another. So when your asset is divided, it hardly makes a difference whether you are an aggressive risk taker investor or a balanced risk taker investor or a conservative. So it hardly makes any difference of the returns. It is more of the asset allocation that you have done.
In reality, broadly speaking, there are three categories of investors: conservative investors, moderate investors, and aggressive investors. The middle path is always best. All those who are taking moderate risk, they are making more money, because when you go into the aggressive investment, you are taking the wrong calls. So the middle path, the prudence is the best. I think you use the word called prudence. So prudence always suggests take the middle path.
No, but Joseph, even if she wants to take an aggressive outlook at her investments, and she's a young lady, she has a lot of time ahead of her, so that could be encouraged. But if she goes through a mutual fund and she uses a fund manager and she does a systematic investment over a long period of time, even that risk gets mitigated, doesn't it?
Yes. You get the dual advantage. There is an expert team of the fund managers. They select the equities, right instrument under the mandate of the specific scheme. Then also, if you have got a sound financial advisor, he will filter what is relevant to you after due diligence, after profiling your risk factors. It is as good as if you are a family doctor. Always he will prescribe the right medicine to you, provided you disclose all your problems very honestly. Here comes the honesty and the integrity and the relationship between the investor and the financial advisor.
Vishal, so there's one thing, which is that my money inside a mutual fund gets spread across at least 30 different stocks. Now, I could have more than one mutual fund, which means that I bring down the risk even further. Ideally, how many mutual funds should I have in a portfolio to bring down that risk?
It depends upon the quantum of investment you have into your portfolio. So ideally, you should not go more than 5 to 7 mutual funds into your, however large your investment size would be.
Why is that?
You need to have a track record of the same. You need to check out every interval that how all the funds are performing. And most of the time, this all mutual funds, if you look at the stock inside the mutual fund, it will be one and the same. So you need not to balance out into a lot of other companies. You could shrink yourself to 5 to 7 mutual funds.
All right. It's time for us to take another very quick break, but stay with us. We'll come back and answer more questions. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. We're talking about risk. What sort of risk do you take on when you buy a mutual fund, and how to choose the right asset allocation to bring down the risk in your portfolios? We have a few more questions we'd like to get through among our audience members. The gentleman in the front, go ahead.
I want to ask that whether mutual fund companies telling us in which companies they are investing my money.
That's an excellent question. How much information do I get from my mutual fund? Joseph?
Excellent. In fact, mutual fund today is absolutely regulated and most transparent instrument. Every information is available. There is called a fact sheet. Generally, it is available in the physical form and electronic form. So if you check the fact sheet, every information, what instrument they are booked, what is the percentage of the money they are invested in the particular equity or the debt instrument, every information is available, and this information is added or updated on the daily basis. That is called a NAV, net asset value. The net asset value is declared on the daily basis. That's the reason it's a most transparent instrument which you have got today.
Vishal, explain to us what a net asset value is. So that how is the NAV calculated at 4 o'clock every evening?
It depends upon the corpus of the fund. Suppose, like you, there can be n number of investors who invest into a mutual fund. So the total value of that investment which is there into that particular scheme, it is divided by the number of investors. So whatever amount comes, it is your net asset value. In the real terms which a layman understand, it is the price that you are ready to buy that mutual fund. So there is also a myth. A higher NAV means a very expensive fund. It is only a myth. It doesn't depend upon the price. It is just transformation of your corpus of the fund into the number of investors.
The gentleman at the back had a question. Go ahead.
Mr. Joseph commented about fixed deposits giving negative returns, maybe at about 8% or 9%, whatever. So if you attribute the same way to say PF or PPF, which also has been hovering around 8.5, do you think that also is a negative investment?
All debt come into the same category, but one special point here I want to mention about the PPF is that here the interest is tax free. So the taxation will not be applicable, but inflation is applicable across all assets.
All right, so let's go back to talking about the basics and talking about the rules. There are various layers of risk that we take. One is the risk associated with the asset class, which is what we talked about, equity or debt. The other one is associated with picking the mutual fund, where I might pick, say, a fund that only invests, and all of us have been through this, in infrastructure. And then the infrastructure sector does badly. And there goes my fund and there goes all of my money. So how do I bring down that risk then that comes with a specific theme? So if I pick, say, an infrastructure fund, or I pick a banking fund, or something even more specific, there are now China funds that you can invest in. So how do we decide whether or not we want to do that?
First of all, analyzing your risk appetite, the entire process is a lengthy process. Your age categories between supposedly 20 to 35 and your investment goals are longer, you can take a little risky investment that you can be more into equities. But however, whatever funds you mentioned about the infrastructure or any thematic fund, they are called thematic fund or sector fund. They come into the last category of from the point of risk. So they give you eye on the high returns possibly and high negative returns also. The highest risk is associated with this kind of funds. So as a financial advisor, unless we know you, we may not advise this kind of funds to you. But suppose if you are constantly investing for the past 10, 20 years and you know, diligently you would like to know, you see an opportunity, for example, maybe a power sector or a pharmaceutical sector, then we can give it to you or you can choose that one, but at the same time risk is very higher, reward also higher.
Vishal, so there's that kind of risk, which is basically putting all my money into one particular theme.
True.
The other one is when I'm picking a mutual fund, I can go large cap, I can go mid cap, I can go small cap. How do I decide which of those I want to do?
Within the equity mutual fund category, there is a specific categorization called a diversified equity fund and a flexi cap fund. What these two categories do, they invest across the board of the equities. So if you want to personally avoid such risk of a thematic like a infrastructure or a sector fund, you can route your investment through diversified equity fund, which touch bases all the stocks and all the categories.
All right. There's one other form of risk that we have not touched upon before we end the show, and that's the risk of the fund manager, where I have the option of picking an ETF or an index fund, which is passively managed, so there's no risk of maybe my fund manager making a mistake that will cost me money. Now, at what point do I decide if I'm an investor who wants to trust a fund manager, to trust one person to make the decisions, or I just want to go into the index and just do what the Sensex or the Nifty is doing?
In reality, if you track the funds, the actively managed funds have delivered more returns than the passively managed funds, that is called index fund. First of all, it is not like a vehicle driven by a single driver. Fund managing process is a lengthy process, it's a teamwork, it's a research. It's not the one individual is managing. Secondly, when you are investing, we shall rightly advise, we generally pick up minimum 4 to 5 mutual funds. There are called subjective factors and objective factors. Objective factors are common for all. Subjective factor comes the specialization of a fund manager or the team. So therefore, risk is almost mitigated when you choose 3 or 4 funds.
All right, so choose 3 or 4 funds, and for right now, in terms of what it costs and in terms of the benefits, you're saying avoid all index funds and just choose actively managed funds. You agree?
Yes. And see, most of the time now, individualistic risk have gone. Mutual fund companies have become more of system oriented. There are investment philosophy which any fund manager comes have to apply that. So it actually mitigates the risk of a fund manager. It is more important to choose a fund house which has a track record and invest in that fund house.
Right. Say for example, all the medicines are available in the chemist shop. So you need to go to a right doctor to get a right prescription, and the prescription is based on the input which is given by the patient. In the similar way, we advise you to have a right financial advisor, and with a financial advisor you need to share all your financial problems and the goals, etc. Only then the financial advisor can give you the right prescription. It's a partnership. It's not that a financial advisor can give any advice in isolation. Initially you need to divulge all the information. So this is a lengthy process. Once you complete the process, you will give the right advice based on your requirement.
All right, on that note, we have to wrap up the show. Gentlemen, thank you so much for spending some time with us. You've been a wonderful audience. Thank you for joining us in the studio. If you'd like to join us in the studio, you can log on to the website indiainvestkaro.com. That's at the bottom of your screen. Or you can send out a tweet, #InvestKaro. Ask us your question. It'll be our pleasure to hear from you. Thank you so much for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.